Hey, what is up, guys? The worst December for stock market since 1931 keeps getting worse. Is this a normal correction or a strong indicator of an upcoming recession? In this video, we will talk about the current economic state and we will go back in history all the way to 1929 and see if we can learn some lessons from the biggest market drop in the history of humankind. The Dow Jones remained under pressure and closed sharply lower again Thursday, aimed a negative reaction to Federal Reserve latest interest rate hike and suggestions that two more increases are coming next year. Investors fear the continued rise in borrowing cost will cause the economy to slow. The Dow Jones Industrial Average fall 464 points or 2%. To a 14-month low of $22,860. The Nasdaq briefly slipped into the bear market territory after dipping more than 20% its late August peak, and the S&P 500 stock index, which tumbled 1.6%, is now down 10.6% from the end of the September, which makes it worst start to December since the Great Depression. According to Bespoke Investor Group, the large company stock index fell 14% in December 1931, according to data from S&P Dow Jones indices. Investors, who are growingly increasingly worried about the central bank causing a recession by boosting interest rate too aggressively, were disappointed in Fed decision on Wednesday not to signal its rate hike planned next year. Stock investors are pushing price lower due to this reason. Politics also roiled markets. Investors were keeping watch on continuous talk in Washington, D.C., which raised fresh fear that lawmakers may not be able to agree on a deal to avoid a partial government shutdown this weekend. The S&P 500 is now down nearly 16% and deep in so-called correction territory, defined as a drop of 10% or more from a high. The current correction is worse than average price drop of about 14% is correction during the World War II, according to data from Wall Street research firm. The Nasdaq, which declined 1.6% on Thursday, is now 20% below its August peak. Nasdaq is nearly an offline bear market, since a decline of 20% or more from its record closing high of $8,109 on August 29. The Russell 2000, a small market cap index, is already in a bear market territory. Now let's look at some warning signs investors might miss before 1929 crash. In the spring of summer 1929, the US economy was riding high on the decade-long winning spree called the Roaring Twenties, but the Fed was raising interest rates too slow in the booming market. Economists and bankers were beginning to wonder how long the party could possibly last. In 1929, popular prognosticators like economist Arvin Fisher swore that if the correction came, it would look like a harmless slump, which others predicted a minor correction. But nobody, absolutely nobody, could have forecasted that stock market drop that had happened in October. On two straight days, double Black Monday and Black Tuesday, the stock market crashed by 25%, and by mid-November it had lost half of its value. When the market collapse finally hit rock bottom in 1932, the Dow Jones Industrial Average had dropped by staggering 90%. Gary Richardson, an economist professor at the University of California, the former historian for Federal Reserve, has reached the Federal in 1929 crash and ensuing Great Depression. He says that first warning signal of looming market correction was general consensus at which stock prices were rising in the 1920s was unsustainable. People could see in 1928 and 1929 that if stock prices keep going up at the current rate, in a few decades they would be astronomical. The question was less about whether the stock market is rising was going to end, but how it's going to end. The global financial industry is now highly sophisticated with some of the best minds and the most powerful computers dedicated to predicting future market movement. In 1929, in the field of quantitative forecasting was not heard. Each leading economy forecaster created his own stock market index in order to predict the future market. Economist Roger Babson was one of the most prominent prophets of doom, including that stock prices were widely inflated compared to the prospects of future dividends. In September 1929, Babson told the National Business Conference in Massachusetts that sooner or later crash is coming, which will take the leading stocks and cause decline from 60 to 80% in the Dow Jones Index. Someday that time is coming when the market will begin to slide off. Sellers will exceed buyers and paper profits will begin to disappear. Other like economist Fisher brushed off fears of reversal, concluding that stock prices were soaring corporate profits. In response to Barbosa's dark prediction, Fisher famously told a crowd of stockbrokers that stock prices had reached what looks like permanent high plateau. That was on October 15, 1929, less than 2 weeks before the Black Monday. Fed tried to put on brakes. Richardson says that Americans displayed a unique bad tendency for creating boom and bust market long before the stock market crash of 1929. It stemmed from commercial bank system in which money tend to pool in handful of economies central like New York City and Chicago. When market got hot, whether it was railroad bonds or equity stocks, those banks could loan money to brokers so that investors could buy shares at steep margin. Investors would put down 10% of shares price to borrow the rest, using the stock or bonds itself as a collateral. Buying on margin let investors buy more stocks with less money, but it's inherently riskier since the broker can issue a margin call at any time to collect the loan. And if the shares price has gone down, the investors will have to pay back full loan balance plus some change. One of the reasons Congress created the Federal Reserve in 1914 was to decrease this kind of fuel of market speculation. Increased rate hikes, bad timing. Unfortunately, the timing of interest rate hike could not have been worse. Little did the Fed know about US economy could reach its peak in August 1929. Tightening the credit market was supposed to shrink the stock prices by maybe 10%, but definitely not 90%. Today, even mainstream news outlets ran stories on financial terms like the inventory treasury yield curve, which is supposed to be a strong predictor of the upcoming recession. Back in 1929, there were fewer such indicators available to investors, but still enough to get the read on whether the economy was expanding or contracting. Monthly figures were published, for example, about leading indications like new housing permits and manufacturing orders. In 1929, it was clear that they had a big boom, but the economy was starting to cool down. Just like today, there was a lot of discussion in the press about whether the economy had reached its peak or not. That all got resolved very quickly with the crash and its aftermath. No big decline has ever been fully predicted. While newbies, middle-class investors seeking easy riches absolutely fueled the 1929 stock market boom and bust, plenty of very sophisticated investors also missed the coming crash. And even those who were expecting some crash did not expect 90% drop. No big decline has ever been fully predicted. If there was any reasonable prediction that home prices would collapse in 2008, then people would stop buying homes. If any reasonable person had foreseen anything like 90% collapse in equity prices from 1929 to 1934, the market would have not gone up. There is a lot of smart people who bet wrong on the market all the time. So, we came to the end. Let me know what do you guys think about upcoming bear market. Can we learn something from 1929 crash? Leave your thoughts in the comment section below. If you enjoyed this video, hit that like button. And if you're new to this channel, do not forget to subscribe for more animated videos about cryptocurrency and financial market. Other than that, thank you for watching. See you next video.